Are you a 100x crypto gambler, or do you do proper risk management when you do leverage trading? Hi, I'm Adriaan and I am part of the team of Bitcoin for Beginners. Welcome at this tutorial where we're going to teach you how not to blow up your BitMex leverage trading account. To be honest, we prefer dollar cost averaging for beginners instead of trading. However, we are aware that many people are attracted to leverage trading like you can do on BitMex and others. Often we notice that people are taking too high risks or even wipe out their entire trading account. That's because margin and leverage trading are often misunderstood and there are many misconceptions. Today we are going to learn more about leverage trading and margin, how to optimally use leverage trading and to avoid 100x, a 6-step process to calculate proper position size, margin and leverage. In this tutorial, however, we will not show you how to make profits, but how to protect your trading capital. Of course, this is not at all any form of financial advice, it's strictly infotainment along with my personal opinion. We strongly recommend to seek the advice of professionals to find out if investing or leverage speculating or trading with cryptocurrency fits your situation. Let's go through some terminology first. What is leverage or margin trading? With margin trading, you can open a larger position with a smaller part of your money and the rest with borrowed money. The position size is the value of the total position, that is your own money plus borrowed money. The margin is that part of your deposit that is locked to finance the position. If the position value drops with the amount of the margin, liquidation follows and the loss is your full margin amount. As you can see here in the picture, this is your total position size, and with 3x leverage, your margin is 33.3%, and liquidation will occur around here when the value of your position has decreased with 33.3%. On 5x leverage, your margin would be 20%, and at a 20% loss of your position will be liquidated. All the way to 100x leverage where your margin is only 1% and the rest is borrowed money. What is a risk amount? This is the amount of money from the trading capital or account balance that is at risk of loss in a trade. It depends on the price difference between entry price versus the stop or liquidation price and the total position size. The trading capital, this is the total amount of money that you have available for trading, and this can be inside but also partly outside of your account balance. One of the benefits of leveraged or margin trading is to reduce the counterparty risk because you only have to deposit a part of your trading capital in your trading account, and you can still trade as if you have full access to your entire capital. If the exchange gets hacked or goes bankrupt, the maximum risk of your loss is then only your account balance and the rest of your trading capital is not affected. Another benefit of leveraged or margin trading is increasing your capital efficiency because you can deploy more capital in various trades. Usually there are two different types of margin available on most exchanges or brokers. One is cross margin or cross leverage. This takes the entire account balance plus your open positions into account to determine the margin and liquidation price. Effectively, the entire account is at risk of total loss on each open trade. Cross leverage is specifically for hedging existing positions and arbitraging, and it's mainly for advanced traders. For beginners and simple trading strategies, it is better to avoid cross leverage. At BitMex, leverage is by default cross, so it's better to change it to isolated if you are not hedging or arbitraging or if you are a beginner. With isolated leverage, each open trade locks only a part of the account balance as margin for the individual position. Liquidation price is determined by this isolated margin amount. The maximum loss at liquidation is the isolated margin amount. The rest of the account balance is not affected. Isolated margin is the preferred setting for beginners and simple trade strategies. For an overview of the difference between isolated and cross margin, at isolated margin, if this is the entire account balance, if you open a trade with isolated margin, then only this part of your account will be reserved for your margin. When you open a trade with cross margin, effectively the whole balance of your account is at risk of loss. Some of the things that are good to know: leverage and margin trading are not gambling tools to get rich quick. With a gambling mindset and lack of risk management, you will blow up your trading account. Leverage in margin trading is a tool for risk management. As we've seen before, it can reduce counterparty risk, it can increase capital efficiency in various trading strategies, and hedging strategies for a broader portfolio, for example, protecting the value of your assets in cold storage without moving those funds. The amount of leverage does not change the amount of profit. Position size does change the amount of profit and the amount of risk. Leverage only changes the amount of margin that is needed for a position. Most important is the amount of risk per trade, not the applied leverage. Furthermore, according to many traders, it is more cost efficient to avoid getting stopped out by the liquidation price, which is set by the leverage, but instead set stop losses well before the liquidation price. And this basically looks as follows. First, in the case of a long position, you will place your stop loss under the entry price, and then when you determine the margin, you make sure that the liquidation price is under the stop loss price. In case of a short position, your stop loss will be above your entry price, and when you determine the margin, you make sure the liquidation price is above the stop loss price. So there are 6 steps to set up your leveraged margin trade properly. First, you determine the risk amount, then identify the entry price and stop loss price, you calculate the distance to stop loss percentage, you calculate the position size with the formula, you determine margin and you calculate the needed leverage, and then you execute an order. Let's look at all these individual steps in more detail. First, determine the risk amount. Risk amount is the maximum amount of your trading capital that you are willing to lose in one single trade if the trade is stopped out. Usually the risk amount should not be more than between 1 to 3% of your total trading capital. For standard trades and for beginners, the risk amount should not be more than 1 to 1.5%. And it's best to use a consistent percentage at each trade. For extremely high probability trades and for advanced traders, a 2 to 3% might be considered. The formula to calculate your risk amount is trading capital multiplied by 1%. Or if you find it easier to type in your calculator, you can also calculate it by multiplying trading capital with 0.01. For the example in this tutorial, we assume a trading capital of $2,000. And 1% of 2,000 is a risk amount of $20. So for this example, $20 is the maximum amount that I'm willing to lose if my stop loss gets hit. What you can also do when you're determining your risk amount is to calculate the risk amount percentage over the new trading capital after each trade. That way the risk amount will gradually increase over time automatically if trading is profitable. Also, it will automatically reduce the risk amount if trading is unprofitable. As you can see in this very hypothetical example, if we start with a trading capital of $10,000, a risk amount of 1% will be $100, and at a risk-reward ratio of 1 to 1.5, a winning trade would have given me a profit of $150. Add 150 to the trading capital, 10,150, the new risk amount will be 102 at the same risk-reward level, but in this time it will be a loss. The loss will be 102. And again, on the third trade, you see that my risk amount has reduced, and each time I make a winning trade, my risk amount will slowly increase. Second step is to identify the entry price and stop loss price. This depends entirely on your personal trading strategy. Second step is to identify the entry price and stop loss price, and this depends entirely on your personal trading strategy. For this example, I assume a long position, and I assume that my trading strategy has given me an entry price of 11,437, and the stop loss according to my trading strategy would be 11,200. Third step is to calculate the distance to stop loss percentage, and this is the difference between entry and stop loss. On TradingView, you can either use the price range tool, which you can find in the left menu, and choose here price range. You can find the price range between your entry price and the stop loss, and it will give you the distance to stop loss over here. And in this case, the difference is 237, which gives us a distance to stop loss percentage of 2.07%. And now we have enough information to go to the fourth step, and that is to calculate the position size. And this formula is risk amount divided by the distance to stop loss percentage will give you the total position size. If we follow our example with a risk amount of $20 and a distance to stop loss percentage of 2.07%, the position size would be 20 divided by 2.07% is $966. So when the stop loss hits and the position of 966 gets stopped out and closed at 11,200, the loss is $20, which is the amount we were willing to lose on this trade. The fifth step is determining your margin by calculating the needed leverage. We found that our percentage of distance to stop loss is 2.07%, so the margin should be more than 2.07%. In this case, 5% isolated margin is more than sufficient for this particular trade. So to calculate our leverage, we need to divide 100% with the margin percentage. In this case would be 100 divided by 5, so 20x is enough leverage to fund this trade. A few more comments on margin and high leverage. 100x leverage is 1% margin needed to open a trade. However, less than 1% price move against you will already liquidate your trade. And a reminder, Bitcoin volatility is currently on a daily average of at least 5%. With 100x leverage, too many trades will be liquidated and the odds will be extremely against the trader. Instead, for trades with tighter stops, which is approximately less than 3.5% distance to entry, set your stop loss order accordingly and never use more than 25x leverage. Tight stop losses require an excellent and very precise timing of price momentum and best entry price identification. This is obviously very hard to do, especially for beginners. Last step is to execute the order. The information we collected and needed for the order were the entry price, the stop loss of 11,200, our position size of 966, and our leverage of 20x. So first we will open the position. We will fill in the quantity, which is the position size of 966. In this case we use a limit order, so we can enter our entry price 11,437. Secondly, we need to change the leverage, which is by default at cross, but we will change it to 20x. And third, we will press buy long. When we open the position, then we can set our stop loss order, which will be a stop market in this case. We will enter the stop price of 11,200, and lastly we set the sell stop. So to summarize real quick, let's go over the 6 steps to set up your leverage margin trade properly. 1. We determine the risk amount, which is trading capital times 1%. Identify the entry price and stop loss price, which is based on your personal trading strategy. And don't forget to also have in place your take profit strategy before you enter the trade. Third, calculate distance to stop loss percentage. You can read it from the TradingView price range tool, or you can calculate it manually by taking the difference between entry and stop price divided by the entry price and then multiply by 100%. 4. Calculate position size with the formula risk amount divided by distance to stop loss percentage. 5. Determine margin and calculate the needed leverage. The margin needs to be higher than distance to stop loss percentage, and the leverage is then 100% divided by the margin percentage. Don't use higher than 25x leverage. Always regulate normal or tight stops with a stop loss order, not by the liquidation price. And lastly, execute the order, open a position and set a stop loss order. Just a few more comments on risk and money management. When you start with trading, do that with a very small account balance and a minimal risk amount per trade. Register every trade in a trade journal to keep track of profitability of your trading strategy. Increase the account balance or trading capital only when over at least 50 consecutive trades you had a percentage of winning trades consistently over 50% and your risk reward ratio, which is losses versus profits, is better than 1:1. Never overtrade, set a max amount of trades and a max amount of loss per day per week. And deposit only 10 to 15% of your trading capital on your trading account and keep the rest in your private cold storage to minimize the counterparty risk. Only deposit more if the account needs more funding after a streak of losing trades. Final thoughts. When margin trading, always apply the 6-step process to determine the position size for each trade. Maybe it looks like a hassle or complicated, but after several times it will become more natural. Apply the other risk and management principles as well, and be very disciplined in following the risk management rules. Don't get tempted to take higher risk, such as too high risk amounts or position sizes. These techniques should help you to prevent gambling away your entire trading account or trading capital. However, on itself, of course, it can guarantee you profitable trading. And remember to also dollar cost average and hodl alongside your trading adventures. Alright, that was it. Give us a thumbs up and let me know your experience with leverage trading in the comment section.